Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Welcome to the Financial Purpose Podcast. This is episode 98. I am your host, Dale Shafer. Thanks so much for joining me today. I want to talk about, because this is in the news a lot over the past week, especially in this week, is what happens if the Fed does cut rates in September. Now, the Fed's widely expected to cut rates. I'm going to try to keep this kind of high level because when we start talking about the Fed and interest rates and monetary policy, you may just like flip over to the next podcast or go back to listening to your favorite song. So stay with me for a minute. This is going to be pretty good information. I think I'm not going to spend a ton of time on this. I'm not going to, do any deep dives and kind of, get into the weeds here. But I do want to talk about this. We're in a situation where we're late in 2025. The market has priced in a couple of rate cuts. We've had no rate cuts in almost one entire year. And we're at a point where the Fed is widely expected to cut rates at the next Federal Open Market Committee or FOMC meeting, which is on September 16th and 17th. So a couple weeks out. But let me talk about the economic backdrop, kind of what we might expect to happen in the economy and in the markets, and then what you can do around all of the noise. So we'll start with the economic backdrop, where we are. Where we currently stand, the GDP or the gross domestic product has been relatively soft this year. Unemployment has hovered around 4.2 or so, which kind of sounds healthy, but we are seeing that job creation is slowing. Inflation is still sticky. Core CPI is still above the Fed's target of 2%. And we have this looming thing, uncertainty, whatever it is, around tariffs and trade policy. And that's keeping prices uncertain and keeping them a little bit elevated. So at the Jackson Hole Summit last week, Federal Reserve Chair Jerome Powell acknowledged that inflation still stubbornly is not completely beaten. There's still some work to do there, but they're starting to get concerned about the labor market. Powell said, quote, this unusual situation suggests that downside risks to unemployment is rising or are rising. The risks are rising. And that's why the market is betting big. And, I think it's widely accepted that roughly 90% of surveyors expect the Fed to raise. They expect the Fed to cut rates in September. And in fact, the market still has two rate cuts priced in yet for 2025. So we would expect them to go in September. If that holds true, then they may go again at the November meeting, possibly heading into the end of the year. But there is something about the labor market that's definitely true. I mean, recent college graduates, as an example, are struggling to find meaningful employment. The unemployment rates for those in ages 22 to 27, so recently graduated or graduated, class of 2023 or before, that hovered somewhere in the area of about 6% earlier this year. And for college grads who did find work, most of them were underemployed or working outside their field of study, which is becoming more and more true. And in fact, we could even go back, and if you remember the Great Resignation of 2021 and 2022, where you could kind of name your price and jump jobs, that doesn't exist anymore. And so it's almost like nobody is really quick to fire, but they're also not really quick to hire either. So it's this kind of stagnated, sort of dryish job market, real wage growth has slowed, that kind of thing. So, quick refresher on why the Fed cuts rates or raises rates. The Fed's job is a dual mandate. They have two things that they're responsible for. The first is price stability, which is controlling inflation. and their target for inflation on a year-over-year basis is 2%. And we've had inflation higher than 2% for, let's call it 3 years now. And we peaked in June, July of 2022 at 9.1%. It's come quite a bit down. We're in the twos now, but still persistently above the target. And actually, we can say that inflation started to peak above target back in 2021, stimulus. So think about what happened after the pandemic. If you can remember those days, it seems like it was forever ago, but it really was just 3-4 years ago. At this point, we're still kind of coming out of the effects of the economic response to the pandemic. But we had rates at zero. We had stimulus being pushed out. Every which way stimulus could be pushed out in the form of direct checks to certain households under certain income levels. We had PPP loans. We had economic recovery loans. We had all sorts of money being pushed out for pandemic relief. And suddenly everybody had more money to spend. I mean, people weren't allowed to charge you rent for a period of time, and there was no eviction and no foreclosure allowed for a period of time. And so everybody just had money to spend, and spend we did. And it went into housing projects, projects around the house is maybe the better way to say that. It went into vacations and travel. It went into the stock market. It went into meme stocks. It went into SPACs. It went into it just went into everything that we could buy. Consumer spending went through the roof. So did inflation. So the Fed in turn raised rates to cut inflation, because if you raise rates, it slows spending and that brings down inflation. When you cut rates, that is intended to stimulate growth. So at this point, where we are, why would the Fed cut? We seem to be kind of at sort of a happy medium, if you will, where things are still good and people are still employed and inflation's not terrible. Everything seems to be kind of moving along, but they would cut rates at this point, not necessarily because they're concerned about inflation remaining high or that inflation is at its target, but it's because they're concerned about the labor risks, and that is outweighing the fears of inflation. Now, of course, there's always the risk that they cut rates and inflation kind of peaks back up for a period of time. And so the Fed wants to ideally prevent a mild slowdown in the labor market from becoming something a little more systemic in the economy or becoming worse. But here's the nuance. Cutting rates now does not mean the economy is booming. It's not booming, but it is okay. But when you start cutting rates, it signals the opposite. It signals that the Fed sees cracks forming in the economy and they're moving to stabilize before the cracks become chasms. And if you think of it, kind of a silly example is kind of like if you're driving and you're heading up a big hill, you're maintaining your speed. Let's say you're on cruise control. And the speed is good, but then once you start to go up the hill, the car has to give more gas to the engine and higher RPMs to be able to maintain the same speed going up the incline. And that's where we are. Basically, we're coming at a hill. The Fed's trying to decide how much gas do they want to push into the engine of the car. Now, there's also a ton of political pressure on Jay Powell and the Fed to cut interest rates. But Powell, in my opinion, through his actions, through his steady demeanor, I don't know that I've ever seen that guy taken off his normal, just who he is. He's not getting wrapped up in all the headlines. He's not taking the bait that's being thrown at him by the president. He's not trying to engage in, grabbing headlines and sound bites and things like that. The Fed is chartered independently from a political standpoint, and it's kind of like let the smart kids do the monetary policy and figure out interest rates and do the economic math and that kind of thing, and let all the other kids do the politicians stuff, and sort of mess around with fiscal policy and dare I say mess up fiscal policy. But Powell's not taking the bait on that. He had an opportunity at Jackson Hole to maintain the independence of the Fed and be very strong about the independence of the Fed. And he didn't. He simply talked about, this is where we see the economy. This is where we see the risks. This is the concerns we have about the labor market. And he sort of signaled that they're on track to do a rate cut in September. So let's talk about short-term market impact based on that. And one more thing I will say is whether or not they do cut rates, you can go ahead and just pencil in a response from the White House because it's going to come. So anyway, okay, let's talk about short-term market impact. And the reason why I think this is important is because there's a lot of precedent and historical precedent for how the markets respond when the Fed cuts rates, when the Fed raises rates, when the Fed stays what we call staying pat, or they do nothing. There's a lot of psychology that goes into what's in the statement that Jerome Powell gives in the press conference after the rate decision is announced. And in the short term, I'll tell you, Wall Street loves rate cuts. And the reason why is because growth sectors suddenly get a boost because lower rates make higher earnings possible. It makes future earnings more valuable. It makes growth by leverage cheaper, which increases margins. And it helps. Now, who it doesn't help, the banks. Rate cuts do not help banks because banks then lose their ability to earn margin on money. And so bank stocks tend to do negatively for a rate cut. They tend to do better in a higher rate environment because the banks can make more money. They can charge more money, that kind of thing. So case in point, last week, the market was down all week over economic concerns and what was happening with the labor market and what was Jerome Powell going to say at Jackson Hole, because last week was the Jackson Hole summit. And he speaks at Jackson Hole. Thursday, markets kind of Friday, nice recovery. We head into the weekend on a high note. All the major indexes are up 1.5%, 2%. It was a great day in the market. And all because he hinted that there would be a rate increase. And so stocks love it. And if rates do get cut in September, we could expect a good short-term rally. How long it will last, hard to say. It depends on how traders read into the sentiment of why the rate was cut, and I'll get into a little bit more of that psychology in a few minutes. So that's how stocks will respond. For bonds, bonds on a price standpoint tend to rally when rates drop, and that's because yields come down. And you have to think of bonds when we're talking about yield and price like a seesaw. They move inversely to each other. So if rates come down, prices go up, and if rates go up, prices come down. Now, we've been in a rates go up, prices come down standpoint for a couple of years now. Bonds have been paying higher yields, certificates of deposits, Treasury inflation protected securities, T-notes, things like that have been higher. They've been shorter term money's been paying higher yields, which means the prices for bonds have been lower. So the absolute return on bonds has been negative for quite some time, and we've had what's called an inverted yield curve for several years now. Bonds in general just negatively performed. It's been a bit of a bear market for bonds after about a 40-year bull market. And so it used to make sense to have a lot of bonds in the portfolio. And by a lot of bonds, it really depended on your risk tolerance. But the old 60-40 model where you had 60% in stock and 40% bonds, that used to be an absolute winner. Just steady Eddie, always going to perform. It's going to give you good returns without a lot of volatility. It was kind of a great thing for retirees. Over the past couple of years, 40% of a portfolio in bonds would mean drastic underperformance because it's going to pull down the overall performance of the portfolio, and it just doesn't work. So for people who are nearing retirement or even just retired and you're looking at another 35, 40 years potentially of life expectancy, you don't want to be too conservative. You haven't wanted to have a lot of bonds in the portfolio because they just aren't working. They aren't paying you anything. And it doesn't make sense to have 30, 40, even 25% of the portfolio into something that's not earning any money or barely paying a yield that gets you above zero. So high yields, short-term bonds have made money. Long-term bonds have not. If the Fed cuts rates, we might see that start to reverse where short-term yields are going to come down. And that means long-term prices for bonds can potentially go up. As far as currency and commodities are concerned, this one's kind of a little more nebulous for me just because I don't pay a lot of attention to, especially the commodities markets. But I can tell you that cuts often do weaken the dollar. That can help exporters, makes import prices better, and oil that can raise the price of oil because the demand for energy will be higher. So if people have suddenly more money in their paycheck, they may drive more. They may go on those kind of last minute summer trips. They may start planning the holiday travel, that kind of thing. So demand for oil can peak up. That's going to take prices up. And then, of course, on top of that, the other reason why prices would increase is because we do have this tariff thing that's happening on certain goods in certain countries and whatever. And so inflation overall in energy can certainly sneak back in and become kind of a negative side effect of a rate cut. So the other thing is that rate cuts now would coincide with lingering inflation that, again, has been a little bit above target and tariffs. And so commodity prices, of course, could ignite a little bit faster than previous cycles where the Fed has been easing rates. So the other thing that's important to note about the dollar is that over the past few years, and last year this happened a lot, is overseas investors were flocking into U.S. assets because the yields were so high. And so it's made the dollar appear to be stronger, and it's muted some of the weakness that would come with some of the other things that are happening in the economy. But if political interference with the Fed continues to escalate, if we have, all these tariffs on and off things and people start to get really concerned about the validity of the, and maybe here's another thing, if we continue to run massive deficits in the fiscal policy side, and that's in Washington, D.C., on Capitol Hill, if the economic stability of the U.S. starts to look shaky, investors will pull their money and they'll go other places. And so that could drive down the dollar, which again has some good effects and some negative effects. But it could cause some issues there. So when we're talking about rate cuts, some of the broader effects, and this is where people kind of get excited, is cheaper money. And so you're able to borrow money at a lower cost. Businesses can borrow money at a lower cost. You can borrow money at a lower cost, which means you're going to spend more. And that actually can kind of help the economy continue to move forward with a little bit of fuel. So see, rate cuts have this effect where they work like a stimulus, basically. And then it allows the economy to continue to go on with some legs left in the tank. The flip side of that, though, is that you earn less money on your cash. And so it doesn't make sense to then sit on higher balances of cash. It can feel like getting a pay cut, especially if you're retired and you depended on interest from CDs to be there. If you've been renewing CDs and collecting interest, that's going to be a little bit more challenging. We've had rates in the high 4s and 5s for a long period of time. You were going to see those potentially slip down into the 2s and 3s if the Fed cuts rates, especially if they cut by more than 25 basis points through the end of this year. And then, of course, I already mentioned this. The other potential risk is inflation can kind of peak back up if we're spending more money. So it's the effect of too many dollars chasing after too few goods. That's what happened in 2022. Too many dollars going out, trying to buy too many things, consume too many things, have too many experiences. Demand followed suit. So demand went up, prices went up. That's kind of the way that works. And so that can spike inflation. So that's really what we want to watch for. But here's something I think that gets missed a lot. And this is on the psychology side that I alluded to earlier, is that a rate cut sounds great in a lot of cases, but I think sentiment eventually catches up for what it potentially signals. And so the question isn't just whether or not the Fed cuts rates and by how much, but it's also why they're cutting rates. And if it's because they think that growth is slowing, sure, stocks can rally, bond prices can go up, people can spend again, things feel a little bit more loose. It's a little bit of a kind of a party. But what happens is if the slowdown is perceived to be real, that wanes, and it can wane fairly quickly. And we really should pay attention to what the Fed is saying about why they're cutting rates, because again, they're not going to cut rates. It's very clear that Jerome Powell is not going to cut rates because of political pressure from the president. And he's not going to cut rates because more and more things are being said about him. I mean, the president has outright called him publicly a loser and stupid and all these other names. And Jerome Powell doesn't care. He's not trying to combat that. He's just basically saying, look, we have a job to do. The Fed is politically independent. The president can say what the president wants to say. If the president wants to pursue a path to try to fire me, and there doesn't appear to be one, but okay. He's just saying, look, that's fine. All of that is noise. This is what's happening in the economy. This is my job. And so we have to pay attention to that. This is also true of borrowing rates, because I have people often say, man, I can't wait till rates are in the threes again because, I'm going to refinance, or I'm going to go buy a house, or it's going to be so awesome. And I hear that and I think, yeah, but if rates are in the threes again, that means that the Fed funds rate is, 1.5% or 1%, somewhere in that range. What's happening to the economy if the Fed funds rate's that low? Think back to 2008 through 2015, when the Fed funds rate was at zero. And then from 2015 into the pandemic, when they were able to get the Fed funds rate back up to somewhere in I don't remember exactly where it landed, but somewhere, let's say, in the neighborhood of 2.5% to 3%, maybe a little bit higher. They had to cut again to zero for the pandemic. Now, had to cut again is debatable. Cutting to zero all the way is debatable. And it took them 2 years to then pull the rates or start to raise rates again, which is also debatable from the strategy. I think the Fed's been in policy error. I've said that for a long period of time, but it's irrelevant because we are where we are and we can't change what they did. But if we think about what happens in the economies in those periods of time when rates are at zero or when they're sub 2, it's generally not very good. And the Fed needs to hold rates low to stimulate growth. It means that people are unemployed. It means that GDP is constricted. It means that we're not spending money. It means that people are losing their jobs. It means that there's layoffs. It means that companies aren't making money. It means that people are taking potentially pay cuts or they're on pay freezes. So not a lot of good stuff. When the Fed starts cutting rates, there's a signal that something's potentially forming and they're trying to stop it. So we just want to pay attention to that. What you should do, in my opinion, if the Fed cuts rates, there's a couple of things. So for investors, traditional wisdom is that you would not chase growth blindly. So if the market's going up, you're not chasing the next, thing to shoot the moon, because we're not in shoot the moon conditions. Now, there are a handful of stocks that have done very, very well this year. Some of them expected, some of them just out of nowhere. And of course, we had from February 19th until about April 10th, the market did go down 20% from its recent high, and then it snapped back. And here's where the traditional wisdom may be something worth considering, is that you always want to have growth for the upside, because growth is always going to be there. We also want to have value in the portfolio, in my opinion, because value over the long run performs as well, sometimes better than growth. And sometimes in recent years, when growth has been the thing, value hasn't performed as well. But we still want to have it there because that can shift at any point, and we never know who's going to lead the market, so we want to own as much as possible. But it also might make sense to have some defensive sectors like staples and healthcare and utilities, just for some additional downside protection or buffer, I guess is maybe the way to say it. Now, here's where that gets really wonky. February 19th, the Fed started talking about tariffs. By the first week of March, the market was already off about 10% and moving down. I took clients of Life Moves Wealth portfolios and took them not out of the market, but shifted them defensively. And about 3 weeks later, the market kicked, and I was watching signals and I was paying attention to trading and I was looking at long-term movement and things like that. All things that just kind of give me patterns, but they don't tell me where the market's going, but they give me some clues. And then I shifted back out of more of the defensive stance back into the growth where we were. And the problem with that is we missed a little bit of upside because the call was I need to help clients protect from this big potential prolonged downside risk of tariffs and trade. And the fact that we were dropping a bomb on an Iran nuclear facility, right? There were multiple things happening in that 3 or 4 week period that should have killed the bull market, or at least put it to rest for a period of time and gave us a little bit of extended volatility, and it just didn't happen. And so I made what turned out to be the wrong call for the right reasons, but still you miss upside. So you have to be really, really convinced that what you're going to do in the portfolio is what you want for the long term. Trying to get around short-term trading, it can be very difficult to make up ground. It can be very difficult to know when to move in and when to move out. And so I would say you don't want to trade on this. This isn't something to trade. What I did wasn't trading. It was repositioning the portfolio for what I saw as potentially being a 9 to 12 month kind of shaking out, because the markets were already at all-time highs. They were already priced to perfection. They were already pricing in rate cuts that I did not see coming anytime soon. And that part I've been right on. I've been right on rates since the middle of 2023. And knock on wood, it's just because the conditions for where the Fed has taken rates just hasn't made a whole lot of sense. But when you look at what's around the economy, you can just say, look, at this point, there's no reason for them to be aggressively cutting. And so I knew that rates were going to be higher heading into 2025 and potentially beyond. And here we are in the potentially beyond. And even if the Fed does cut rates 25 basis points or 50 basis points, we're still in the beyond, and rates are still going to be elevated headed into 2026. So with the stock market especially, I would say position how you feel is best for your risk tolerance. Definitely, and I'm going to say this because ultimately I'm bullish on the long-term prospects of our economy and of our country and of our ability to produce and innovate and change and grow and industrialize and, continue down that path. And so to me, it's always, always, always going to make sense to be allocated to something that's growing, to whatever the next thing is, to something that intersects now, AI, semiconductors, those kinds of things. And again, these are not investment recommendations. These are just how I'm seeing the positioning of the portfolio. But it also makes sense to have a percentage of allocation to value stocks, and it makes sense to have a percentage of your allocation to defensive things. One of my favorite things, one of the advisors I trained under once said, "I never know what's going to win. Leadership changes every year. I don't know how to pick the winner. Nobody does, so I'm just going to own as much of all of it as I can." And then from there, we decide how much of all of it goes in the portfolio. If there are 13 sectors in the S&P 500, let's have exposure to all of them and then decide what's going to make sense. And sometimes it doesn't make sense to have one of them in the portfolio because they're just not doing well. And it can be very tempting to sell your losers and let your winners run. But sometimes, again, that can shift, and you never know when a sector is going to be the performer. And traditionally, whatever wins this year is not going to be what leads the market next year. And that's just kind of the way that works. And so you have to just know what you own, know why you own it, what you expect it to do, how long you want to own it, and when you have a clear signal that it's time to make an exit. And if you do that, you're going to have periods where you're going to perform better than other people, in maybe the broader market or in maybe your benchmark, and you're going to have times where you underperform those things, and you just need to say, this year we might be doing well or not. Last year we may have done well or not, but over the last 5 years, 10 years, 3 years, think longer, look longer, your returns do tend to kind of average out, and then you can have some consistency. The same is true for income seekers. Diversify your income streams, especially if we're looking at bonds. I have always been a fan of kind of middle duration bonds. I like things that mature or we're able to kind of recuperate our investment. 5 to 7 years is a good maturity. The reason why I like that is because the front end and long end of the curve. So short-term interest rates, long-term bonds kind of do this over time. And I just like to be kind of right in the middle where it's kind of steady and then let it slide a little bit back and forth based on the allocation. So just be very careful where you're pulling your income. If you're in a situation where you've been used to having high income or high yielding bonds that also have good price appreciation, that may change if the Fed cuts rates. And so you want to be prepared for that. If you have a lot of cash sitting in a high yield savings account, you may be prepared for that yield to decrease as the Fed cuts rates. Business owners, lower rates mean lower borrowing costs. That could be a great chance to refinance debt. It could be a great chance to go ahead and fund some expansion. Maybe you shore up your working capital. Maybe you get your credit cards situated. Whatever it is, it gives you the chance to look at your debt structure and realign it with new cash flow realities. Now, new cash flow realities may mean in the short term that people are spending more, but it also could mean that people read rate cuts as being uncertain, and so they may pull back spending a little bit, or your particular sector or your particular part of the market might be impacted one way or the other. So you just have to pay attention to that, watch your trends. So what's the bottom line here? As I kind of close up this episode, the Fed rate cut, again, it may feel like a great party. It may feel like everything's going to rally. Things are just going to keep going up and to the right, but it's not necessarily all champagne and confetti. It is a signal of concern. It can create opportunity, but it can also create a little more volatility. So it's a good time to align your strategy and your thinking, not with headlines, but with what's most important to you long term. The Fed cutting interest rates in September is a September story. It's not a 2035 story necessarily. Now, what they do, long-term effects could impact that. But we want to think about what's most important to you over the longer period of time, because what the Fed does now or doesn't do now, what the headline says now or doesn't say now, where the dollar trades, where the stock market trades, all of those things matter today, but they won't matter tomorrow. They won't matter in 10 years. What's going to matter is what are the choices you've made for the way that you're going to build growth and wealth for yourself. And how do you stick to your guns when things get rough? How do you maintain your conviction through the hard times? Because if you maintain your conviction through the hard times, then you're going to end up with better long-term investment outcomes. So it's a great time to get aligned. If you want a deeper dive into what all of this might mean for your portfolio, for your financial plan, please send an email to info@lifemoveswealth.com. Or go to lifemoveswealth.com and click the schedule time with me button. I would be happy to talk with you through the considerations that you might have, through the concerns that you might have. One thing I will not do, just in all full transparency, I really won't put a lot of stock into wherever you feel about like politics and who should be saying what and who should be running what. That kind of stuff, I really don't care about. It's not important to me what the president says. It's not important to me what anybody else says. What's important to me is what matters in your home, what happens in your head when you're trying to go to sleep. Where are your thoughts about your long-term financial, career, wealth, family, all of that stuff, business? What are your long-term goals? And that's where I want to put the focus. That's where our energy is best spent. That's where our efforts are going to be best realized. So if you want to do serious financial planning and you want to think about how the future can play out for you, you can only do that through the lens of planning. We can't guess at it. We can't hope for it. Hope is not a strategy, but we can absolutely do everything we can to plan based on what we know today for an outcome that we want most tomorrow and beyond. So that's what I have. Thanks so much for listening to this episode. Again, questions, info@lifemoveswealth.com. Go to lifemoveswealth.com. Learn more about the approach that we take. Hit that schedule time with me button, and I'll see you hopefully in one of those meetings. But until next time, on the next episode is when I'll see you, or I'll be talking to you next. And until then, go be a boss. Take care of yourself. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.